In fact, we have a guest with us to talk about the Reserve Bank of India policy reaction, markets, life beyond, and everything that's happening in the mutual fund space. Shailesh Raj Bhan is our first guest on the show. He's, of course, CIO, Equity Investments at Nippon India Mutual Funds. Shailesh, great to have you on an interesting day, right? Every day is interesting in the market. Today, maybe more so. But you tell us how you sort of are looking at the overall construct right now. At least this one policy is out of the way. But so are earnings. And, the market's now looking forward to more cues like what's happening to U.S. inflation. The short point is that do you think there is more ammunition, more fuel to take the rally higher? Or do you think this market rally for now will stall and, maybe we're in for some consolidation?
See, the earnings have been fairly better. If you look at how the earnings have come off, they've generally been a little better than, what people have anticipated, primarily because of a sharp reduction in commodity prices and raw materials, right? But overall revenue growth has been fairly moderate and muted. So I think we have to be clear that we are not today even in this very, very strong earning environment, which I think over 3-4 quarters we should reach there, because that's always a journey, right? So given that construct, markets are certainly done exceedingly well, right? And I think it is possibly the time where people come back with sanity to look back at valuations, look back at time horizons from here. If you want to invest, at least a 3-4-5 year horizon is important. And there are certain international risks which continue to remain. The China recovery has been softer, and generally the inflationary challenges still remain to some extent. It's not become a kind of a very easy inflation environment today. So on a macro front, certainly it's not very, very easy. Oil has also moved up significantly. So on a broader market basis, we think consolidation is what possibly is a reasonable outlook to watch out for or look out for.
Shailesh, morning. Rima here. What have you made of the RBI policy? The inflation forecast has come in as a bit of a shocker. It's taken the street by surprise, higher than what most of the economists were forecasting. Do you think the RBI is being a bit conservative? Maybe they're overestimating right now, keeping in a bit of a buffer because they don't want to be seen constantly revising their inflation forecast higher. How would you read it and the implications for the market?
See, I think the reality is, I would say it's more a realistic expectation of what's happening around, right? And the core construct of the market from where we stand today, all the large macro variables are reasonably fine for the economy to come back to good growth from the weak 4-5 quarters we have seen. So from an RBI approach, we find it rational and realistic. And clearly, a lot of things are still yet to pan out, right? The impact of higher oil prices if they continue to remain here. So there are some risks which always remain in the open. But I think the current construct and the current availability of liquidity in the market is fairly good to allow for investment cycle and growth to come back. And it's always good not to have large shocks every 6 months or 12 months, right? So it's better to be a little bit conservative, but I think the approach is realistic.
Okay, got that. Hi, Shailesh. Thanks for joining us. This is Pavitra. Tell us then, how do we approach this kind of market? Where do you still see good pockets as opportunities if you were to look at the market right now? And also separately, just a view on the Nifty Bank from here, because, aside from today's, move, it has anyway been a bit of a, the drag on the market. So how would you look at the Nifty Bank, and where else do you see opportunities within this market?
So starting with banking itself, right? If you look at the market construct today, banks today on a simple valuation parameters are very sensibly or reasonably valued. So there is no significant euphoria there. Books are clean. Growth is inching and coming back. And we have seen a little bit of margin pressure, but fine. I think over a period of time, growth will take care of a lot of these things. And the construct is the whole investment cycle ahead of us, the whole energy transition opportunity ahead of us. It needs a lot of capital, and these banks with strong balance sheets are well placed to capitalize on that. So I think it's not a challenge. You always have near-term underperformances in certain sectors because of over ownership or things like that, which is fair enough, I think. But from a valuation and construct, the banking side looks reasonably good. Please understand, we are not at very cheap markets. So return expectations should also be more moderate from where we stand, even for the banking space. But within available options, banking is a good option to participate in and stay there. About other spaces where there are opportunities, several of them in select pockets exist. Like, utilities is there, which is investing significantly for the transition. So they have a growth element coming back to them. So that is an important space where valuations are still way below the other parts of the market. Then you have pharmaceutical space where valuations are sensible. There has been some recovery, but the medium-term opportunity there remains long and can compound. Then so these pockets are fairly interesting. In select spaces, valuations have run up very, very sharply. So they factor in near-term growth like engineering and manufacturing, or select areas where multiples are reaching 40, 50 times, or select small cap or even smaller cap businesses where we have seen significant price increase of 30, 40, 50% in a month in a lot of companies. So those challenges remain, but I think the core part of the market is still okay for very moderate return expectations.
Okay, I got that. Gives us some sense of sort of the areas that you are a little more comfortable with, Shailesh. So now I want to come to this innovation fund that you folks at Nippon are launching. And I want to, really start by asking what constitutes innovation for you? I mean, you could be looking at platform companies, and some of them are now actually posting profits. There is the original IT services area, but there's a lot of issue with global headwinds over there. I mean, innovation can cut across any sector, right? But specifically, what is it that you like in innovation?
So it's a very interesting point, and when we're constructing the fund, a lot of debate went into getting it. See, the reality today in India is, I think the last 20 years which have come about, right, and the next 20 will be way different in terms of where companies allocate capital, what type of investments they do in R&D, what type of businesses gain market share against our traditional set of companies. So what's happened in US in the form of innovation has not really happened in India to that degree, and I think that whole space or that whole opportunity or transition of our economy from a traditional biased economy towards more new age businesses, towards differentiated companies and new sectors. I think so. There's a large opportunity which is emerging. The clear definition for us in terms of innovation is innovation should give some tangible advantage to those companies which is sustainable. Either it could just be a business model innovation, which means some companies are enjoying much higher profitability and much higher growth because the way they have designed their model, which is more sustainable. So there's a lot of business model innovation which is possible. And some people within the same sectors today are enjoying 10% higher margins, 10% higher growth rate on a compounding basis. And that's by design. So that's by a edge they have created. The second is there are a lot of companies now investing in R&D. You'd find some companies, especially the pharma side today, having maybe invested $1 billion or more in research and development to allow to fight the premiumest of the markets in the world, the US, and on a branded basis and not on generic basis and non-commodity basis. So there are a lot of such opportunities there. The third area obviously is the whole new tech, new age, disruptor space, which is there, which is now coming of age. And the beauty is that space today doesn't have the capital because of drying up of capital on the venture capital side. So all of these will get listed. Some of these SaaS businesses will come into play. The new age companies are now working towards profitability as their main goal, not growth at any price, but still continue to have the advantage of being disruptors there. So the consumer tech, food tech businesses. So the model has to provide an edge which allows for sustainably faster growth than the market. Second, it has to be either the construct itself allows for better profitability, or third, the construct itself create new markets which didn't exist in the case of food tech businesses. So I think these are the clear definitions which we have for innovation. And our approach will be nearly 80% of the money should be in these type of businesses. And hence, the construct, the design and approach and the universe we are creating works around this kind of a design.
Shailesh, will be most interested to see what kind of stocks you select in this innovation fund once that list is out. But thank you very much for joining us today and wish you all the very best. Get into a break. On the other side, a whole lot of stocks are moving in trade this morning. We'll get you more on that. Stay tuned.